Hi everyone, welcome to the first video of the mock exam solutions. Feel free to watch these as many times as you want, work through them, ask questions. I know that some people have been emailing me asking questions prior to this period. I had specifically not been answering those because I did tell you it was holiday, don't do anything, work on your project. And there was some things that needed ironed out and corrected in these anyway. So as from today, feel free to look at them, go through them, work through them, bombard me with questions. Most of the time when people were saying I've spotted this mistake, it is because it was a mistake in the answer. I had to rework 2 of the answers because I'd made a calculation error. So they have now been fixed and will be uploaded as well. We're going to start with question 1A at the beginning, the corporation tax. I do have 2 boards here, so I'll be flipping in between them because we'll do them in 2 different sections. And if you hear some scuttling about, it's because my dog's in here with me. But I have the question and the answer down here as well, so that if you see me looking down there, that's what's going on. But this first question, corporation tax, really comes in 2 different sections. And the first section is very straightforward. A standard corporation tax calculation always has exactly the same elements in it. Adjusted trading profits, capital allowances, chargeable gains, QCPs. And it is profits minus capital allowances plus chargeable gains, or minus, if it's gains or losses, minus QCPs. That format will always lead you to TTP, to divvies, to augmented profits, to tax. That's the structure, it doesn't change. And almost all of these numbers come from the question. So adjusted trading profits we can't do yet because we've got an adjustment to do that we'll do down here in a minute. Capital allowances, it gives us that. 175. Chargeable gains, we work out later on and we'll come back to it. QCPs, 13. Dividends, 95. So we have to adjust the profits and calculate the chargeable gains. That's all we have to do in this question. So we have to look at the profits we're given and looking at the information underneath it and decide whether we need to make any adjustments. So we'll do this down here. We know that our trading profits is 1400,750. That's in the question, it gives it to us. There's no special trick there. It is the first number you are given. Then we look through the list and we have to decide which, if any, of these items are not allowable for tax. Directors' fees, yeah, that's fine. That's the salary of the directors. They are allowed. They stay in there. Bad debts written off. That's fine. It says written off. If it said bad debt provision, that would be different. We would have to disallow it, but it doesn't. Depreciation of tangible assets. Depreciation always needs added back for corporation tax. All non-current asset items are dealt with under capital allowances. So anything to do with non-current assets, whether it be profit or loss on disposal or depreciation, all needs reversed out of there. So depreciation needs added back. The next one, profit on disposal of assets, that needs taken off because it's income. If it was loss on disposal, you would add it back. But this was recorded as income in this figure and it shouldn't be. So that's let's not put that there. That 17,500 needs added back. And the last one, customer entertaining, not allowed. If it was staff entertaining, we would need to know how many staff members there were because it is £150 per member of staff is allowed over the course of the year. So the customer entertaining there is also not allowed. That's all of them, and it gives us an adjusted trading profit of 1490250, and this figure is what we put up here. Now, at this point, the only figure we have left to calculate is the chargeable gains. And that we know with indexation allowance is slightly more complicated. So that's the last bit that we do, and it's going to be put in here. Once that goes in there, this is all sums. There's no more workings to do. So you can do this part of the question very quickly and very easily. All we have had to do is this. This is, can I remember the format and table of a corporation tax calculation? And 3 of the 4 numbers were copied out of the question. So I'm going to take this board down. We'll come back to it in a minute. I'll just put it over here. And now we're going to look at the second part of the question where it calculates the chargeable gains to be reported in the company. Now we know that this is going to have our table with shares, cost, and indexed cost, and we are going to calculate it in going through every transaction. And we know, because it tells us in the question, that on the 1st of May 84, we bought 4,000 shares at a cost of £8,000. And at that point, the index cost is exactly the same because no time has elapsed between the two. So the index cost is also £8,000. And then we're going to move forward. Now, technically, we must index to April 1985 because that's when indexation allowance starts. So you do it in 2 stages. You go from May 84 to April 85 and from April 85 to the next time in the future. And that's the way I'm going to do it on here. You can do that all in one go. You can just go from May 84 up to whenever you need to do in the future. It will give you exactly the same answer, but this is the full way of doing it. So, April 85, we need to do the indexation, and it is new minus old over old, and that gives us 0.088, and it is 0.088, which we then multiply by the indexed cost up to that point, and that gives us 704. So after that indexation, we have 4,000 shares at a cost of £8,000 with an index cost of 8704. And then we look forward, and the next transaction actually takes place in February 2004. So we then need to put this forward to Feb 04, and it's exactly the same process, new minus old over old times indexed cost. And that gives us 187.6 minus 94.78 over 94.78, and that equals 0.979. And that's the calculation that I got wrong when I did the original answer that went up. So that then comes in there, and that is now multiplied by this figure, 8704, and gives us 8521, which now gives us 4,000 shares at a cost of 8,000, but with an indexed cost of 17,225. Because by this point, we have owned these shares for nearly 20 years. So the index cost has almost doubled. At this point, we bought some new shares, and we bought those shares on the 4th of February 04. We bought 2,000 shares for £4,500 at a cost of £4,500. That then gets added, and at this point we have now bought 6,000 shares. They have cost us £12,500, and they have an index cost of 21,725. Now the next transaction is the sale, which takes place in March 2021. Now indexation allowance stopped in December 2017, so we can only index up to that point. And again, new minus old over old equals 0.482, and that is multiplied by this figure to give us 10,472. And at this point we have 6,000 shares that cost 12,500 with an indexed cost of 32197. And then we have our disposal. And our disposal is 3,000 shares. So we're going to sell, I'm doing this down here, and I hope, can you see that far down? Yes, you can. 3,000 shares, but we own 6,000 shares. So that becomes our disposal fraction, 3,000 divided by 6,000. Because when we get rid of the 3,000 shares, we have 3,000 left. Now what we do is we say the cost there is 12,500. We multiply that cost by this fraction, and that tells us exactly how much of that cost has been disposed of. In this case it's really easy because it's half. So that becomes 6250, and that becomes 6250, and the last one is 16098, and that is 16098. And what this is now telling us is we sold 3,000 shares with a cost of 6,250 and an indexed cost of 16098. And that is what we put in to work out in the disposal for our gain. So I'm going to swap the boards back over so that we can do the gain on that one. So it tells us in the question that we sold these shares for £40,000. We worked out on that table that the cost of those shares was 6,250, giving us 33,750, an unindexed gain of 33,750. Now we have to do a slight calculation because we know the indexed cost and we know the cost. So the indexation allowance is the difference between those two figures. So we knew, so our indexation allowance is 16098, which was our indexed cost in that table, minus the cost here. And that gets us 9848. So basically this number and this number add up to the indexed cost that was in the other table. So that tells us now that we have a chargeable gain of 23902. And that's the figure that we now plug here. And this now becomes just a sum. So we take this, minus this, add this, minus this, and we are left with 1,326,152. And then when we add the dividends, that gives us 1,421,152. The significance here being that figure is less than 1.5 million. So that means that they do not have to pay their tax installments. They can pay it in one single tax liability. So our corporation tax becomes this figure times 19%. So the amount of tax they must pay, 251,969. And because they are not paying by installments, that figure is due to be paid by 9 months and 1 day after the year end. So on the 1st of January, because that's 9 months and 1 day after the year, that must have been paid. Therefore, it must be paid. If it's got to be paid before the 1st of January, then it must be paid by the 31st of December. That's the confusing bit here. The 1st of January doesn't mean you can pay it on the 1st of January. It must be paid by the 1st of January. So it needs paid by the 31st of December. That's the last day you can pay it. The return, however, you get 12 months. So the return would be due on the 31st of the 3rd, 22. Those two boards is that question. It was a 14 mark question. The only bits we had to do a very small calculation here in this little adjustment. This is the only figure that we had to do anything with, really, other than just read it and decide whether we could put it in or not. We had to calculate something. You need to break this question down into two different bits. Setting this up and leaving a gap there, then put it to one side. Then doing all of this so that you can then get back to calculating this to put in here. It's not saying it's easy, I'm saying that it's quite straightforward if you break it down into those different bits. So watch this video as many times as you want, look at the answer, look at the question, work through it yourself, make sure you know what's going on with it so that you can trust that process when you come to mock paper 2 and try and do it without these videos so that you have to just work through it yourself. Okay, I'll see you again.